Good morning. It is Monday, April 17th. I hope you had a great, I guess today is the last deadline to file taxes, huh? Because 15th was on a Saturday.
Oh yeah, yeah. I don't
I,
think so.
I think today is the tax deadline. So if it's not, then I apologize. But hopefully you've filed before now, because it would stress me out if I hadn't filed yet. Um, but let's start off by talking a little bit about recent economic data, Tom, because for whatever reason, and maybe you can enlighten me, the market expectations for Federal Reserve rate increases have just gone up and up and up. In fact, now we're talking about potentially exiting the year with maybe a one rate cut versus I think we were talking about three rate cuts just maybe a week or two ago. So talk to us a little bit about what you're seeing in the economic data and why we might be looking for just one rate cut by the end of the year.
I think that for last week, I think it was twofold. I think the first was that CPI was heavily favored over PPI, which is to say that the CPI number came in essentially flat. The PPI number showed considerable reductions on inflation, and I think people were hoping for more. And since they didn't get it, at first there was a little bit of a muted positive response, and then that kind of faded away over the day. Then on Friday afternoon, we got the University of Michigan sentiment, which is, basically they have their own read on inflation. They put out a short-term and a long-term inflation number, and they actually bumped up the one-year inflation significantly. They bumped it up from 3.6 to 4.6.
I was shocked by that, and so was the market.
The market was very surprised. And I'm not sure how they calculated that so differently from the Fed, but I think that, that was definitely not in expectations. And the bond market heading into a weekend decided to take that for what it's worth, which is that it's probably more credible than the Fed. Though I think in terms of what we're looking at, we tend to disagree. I mean, I think we're about to hit a cliff on housing. I think that we're about to hit a cliff on the jobs market and wages. And that's going to push the overall number down very quickly, I think. And it's sort of baffling, to be honest. I'm a little bit confused as to where they're getting these numbers or what they're projecting based on. But I mean, I think we're probably going to hit a cliff on vehicles at a certain point, and we just almost have to.
We're already seeing Tesla cut prices.
Yeah, we're already seeing price cuts. So it's an interesting development, but in the short term, and I've said this kind of the whole way through, which is that we need to prepare for rates to come down, because I think that inflation is probably going to come down. But at the same time, risk remains to the upside. If the Fed continues to hike rates, if rates sell off, you have far more loss than you have gain. Should we see interest rates, come down? So again, we're trying to stick pretty tight, unless we can find opportunities that are superior to the 2-year treasury at this point. We need to continue to funnel money that direction, because it's an unbelievable opportunity. And 2 years is a very long time, especially in this market. And be opportunistic on the long end with some of the stuff that we can say, hey, we'll lock in for 10 years at a tax equivalent yield of 5.5%, 6%.
When you're getting a bonus on that, it makes sense. When you're getting a 15-year muni that pays significantly above the 15-year treasury before taxes, that's when it really becomes attractive. So if you can get those deals, or if you can get mortgage-backed securities 100 basis points over where it should be, then you get a little bit margin of safety there.
Yeah.
But if you're just buying a straight 15, 20-year bond right now, you're still stomaching a lot of duration risk.
Yeah. And even if you're doing something like buying intermediate term corporates, I mean, those spreads aren't very wide. I mean, you're looking at 100 basis points over. You see a big move like we saw on Friday, and suddenly you're underwater. And not only that, but the credit quality is not there. You're worried about, 2024, we've talked about it a lot. There's a maturity wall there where there's a lot of bonds that were issued. They mature in 2024. They've got pretty low coupons. And in this new interest rate environment, if they hit that wall where you've got $1 billion, you've got to pay off or issue new bonds to cover that, you're not going to get a better interest rate. And that's going to create a big time credit crunch in corporate land, especially high yield corporate land, sometime in the next 8 months. And so, that's something you got to be careful too, because it may seem cheap, but you also have a probability of zero, if you run into a maturity wall and the company that you've invested in can't pay. And so it's pretty touch and go here. But I think that for now, it's very much a punt and play defense scenario, which is, hey, we can get excellent yield for 2 years. Uh, Even better yield is 6 months. Let's continue to hammer those with bonds that are coming due, take gains on the equity side and buy those and lock in and stay very stable. And then once this really shakes out, which is either the Fed stops hiking or they start to cut, or potentially they continue hiking, we have some read on it, because if they continue hiking, those bonds will be rolling off very quickly and we can reinvest higher and suffer almost no downside due to duration. And there's no credit risk there. So it's really trying to play that, that web of where the value is. Is it, because you've got interest rate risk, you've got credit risk, you've got, all these different moving pieces, and you've got the Fed, you've got to fight them the whole time. And so it's just a very dynamic environment right now. And so I think that safety is key, credit quality is key, interest rate sensitivity. You've got to be very mindful of that in order to get through this environment.
I think if you're asking me, I think there are three real driving factors of why the expectation for rate hikes is going up. Number one is gas prices. I mean, you've probably all seen it. It's more difficult now to get gas underneath $3.50, at least anecdotally from what I see, versus, a month ago, I was easily finding gas less than $3 a gallon. So I think that's number one. Point number two is I do think that there is a line of thinking from analysts out there saying that March was the bottom. We all know the retail sales weakened in the month of March, but analysts are saying that was the bottom, in part because there are easier comps going forward. That is true in some respects, but it doesn't really negate the fact. I don't think we live our lives on a year-over-year basis. We live our lives on a day-over-day basis, month-over-month basis. And then the number three is the banks. And we had some good earnings out of the banks on Friday. But again, I would not read too much into that because of because these are the big banks who should have been doing well anyway. And even then we saw we're still seeing deposit outflows. On the gasoline price side, I think a lot of that was due to the OPEC plus supply cuts. They just cut 1 million barrels and the price of oil went to the $80 range. That's not a whole lot, frankly. Like the fact that we're only in the 80s after they already cut global production by 1%. So, I think that the underlying trend of inflation is downward, but we got to keep watching these three items as we go forward. Moving on, Merck is making a deal to acquire Prometheus Biosciences at a 75% premium to Friday's close. They'll acquire it for $200 a share. It closed on Friday at $114 a share, expected in Q3. The company develops immune treatments, but doesn't yet have any approved products. In fact, analysts expect them to do about $1.6 billion in revenue in 2029. So, I mean, you're talking about a big speculative deal here by Merck. At the same time, this is something that they need to do because they have such a big portion of their revenue and earnings tied up in this blockbuster cancer drug called Keytruda. It generated $21 billion of the company's $59 billion in sales last year, and that patent expires in 2028. So they're trying to layer in some of these new drugs in order to compensate for the decline in that. Now, you might be able to get new patents on it and extend the patent life on Keytruda, and I would expect Merck to be able to do that. But another piece of that strategy has to be able to leverage that cash flow and buy other companies at the same time. Google is under the microscope today. There's a New York Times report this morning yesterday saying that Google may lose its search on Samsung devices as Microsoft's Bing becomes the search engine of choice on Samsung devices. This would be really significant. Google makes about $3 billion a year from this relationship with Samsung. Samsung ships 261 million smartphones in 2022. They all run Android. So the fact that you would actually take Google as the primary search engine for an Android device off is very significant. it's a smaller deal than the Apple deal. Apple's about $17 billion for Google. Samsung's about $3 billion because you have different devices. Obviously, Apple has a lot more valuable customer base. You can make a lot more money from that. Samsung's just $3 billion, but it is something to watch. And I do think that Microsoft is getting excited and is really poised to bid strongly for some of these rights in order to be the premier search engine on these devices.
Yeah, it's interesting. They actually had a 60 Minutes, I don't know what you call it, story on Bard last night. Came on right after the golf. Shout out Jordan Spieth. He blew it in a 3-hole playoff. He had 2 chances to win and did not. But that kept me watching the TV until 60 Minutes came on. But it was interesting because they're talking about the market share that Google has and how that's kind of up for grabs. That they've got 90% of PC and laptop searches, but they've only have 70% on smartphones. So if this flips, potentially to Microsoft and Bing gets that could be a major erosion in there already. I mean, it's a big difference between 90 and 70. So if you're on your phone, there's a fair chance you're not actually using Google. And if they switch that on Samsung, I mean, Samsung's got to be the second largest provider, at least in the US. I mean, that could be a major erosion of their market share in what most people use to Google now. I mean, it's not like you're trying to figure out where somebody went to college while watching a college football game or NFL game and go to your computer to search it. You're going to look it on your phone, which is primarily where people search things these days. So that could be a major, major hit to Google.
Yeah, so we'll have to watch where this goes. Ultimately, I expect that market share might actually remain relatively stable over time because I think consumers will make the choice that they want to make, and you can switch your preferred search engine if you would like. That said, I think that Microsoft is really coming after this as a profit opportunity, and really as to destroy profit in the space. And at the same time, you have Samsung. Samsung is not in a good position right now. They're dealing with the worst market in memory chips that they've dealt with since 2008. They can't sell any big screen TVs anymore. They're all smaller screen and consumer devices. The smartphone market is in recession. Even Apple's seeing fewer smartphone shipments. And so if I'm Samsung right now, and I'm helping Google to the tune of $3 billion, I'm going to start auctioning this off, even if I still plan to go with Google. At least say I'm open to using Microsoft, and let's get this bidding war started and force Google to pay me a little bit more. That's what I would do if I'm Samsung. The question is, again, that's just $3 billion of Google's revenue. Apple's $17 billion. Does Apple do this as well? And I think that Apple doesn't really care about helping any of its suppliers. They don't care about helping Google. They don't care about helping Microsoft. What they do care about is being ruthless and doing what's best for the customer. Right now, I think that's probably Google, using Google as a preferred search engine. But if Apple starts to move toward Microsoft in terms of using them for the search engine, that's where it really starts to become a tricky proposition for the likes of Google.
Yeah, what worries me, and we've talked about this a lot too on the calls, is that too much competition is a bad thing. Once everybody starts, fighting tooth and nail for one area of the market, profits suffer for everyone involved. That's why airlines never succeed, and ultimately they all go bankrupt, is because it's a commoditized product. They're fighting tooth and nail for every dollar, pushes prices down, which also pushes profits down. So something to keep an eye on, particularly with Google and Microsoft. Maybe Apple is a secondary piece there, but I do worry about the high level of competition there, potentially pushing profits down over time.
Yep. All right. Going forward, we did have Schwab earnings this morning. I think their deposits were down 30% on a year-over-year basis. So I'm curious to see how that stock trades. They still have a bunch of held to maturity positions. Again, we are not concerned about the solvency of Schwab, or rather, actually, like the ability that your assets will be safe at Schwab. But I would love to see them reduce that hold to maturity portfolio and stabilize their funding base a little bit more. We do have JB Hunt this morning, this evening. That'll be a really good gauge on the state of the trucking industry and also rail. They actually have a bigger rail business than they do have trucking business. Not a lot of people really talk about that though. But we also have some of the banks tomorrow morning, and then we have the Fed Beige Book on Wednesday afternoon. Tom, what are you looking for this week?
I mean, for me, I'm just really hoping that we see a stabilization in rates. We're just seeing such a sell-off. I don't know. It's really just kind of a grab bag. I would say I'm interested in Proctor. On Friday, Staples have suffered maybe a little bit more than I would have expected. I just don't think we've seen a lot there. Just particularly heading into recession, you'd think the Staples would be a great spot to be, but they've done so much price pushing. And I'd be interested to see if they're continuing to do that, particularly, on the diaper side, selfishly.
We have some more banks tomorrow. We have Johnson & Johnson tomorrow morning, Netflix Wednesday, tomorrow evening. But Thursday and Friday morning are some of the very interesting ones for us, at least from a portfolio perspective. We do have relatively sizable positions in American Express and Philip Morris, as well as HCA Healthcare, the hospital chain, Procter and Gamble, as you mentioned, and Schlumberger will be a really good read on the oil and gas service space. So we have a couple holdings there in the likes of Champion X and NOV. So it's going to be a busy week. It should be a very illuminating week, and we hope it's a profitable week. So that's what we're looking for. If you have any questions, please do let us know, and we'll be here tomorrow.